Good morning, everyone, and welcome to day 3 of the Singapore Trading Festival 2022, brought to you by SGX and Equities Tracker. If you missed out anything from the first 2 days last weekend, not to worry. We have recordings available for you on our website. They will be up very soon. Just a reminder also that the presenters and panelists today will all be speaking in their professional and personal capacities. So now we also want to do a quick tour for you of the exhibition area. So if you are in the main lobby, let's take a look at the bottom left corner. If you click on that exhibition with the arrows, then you'll be able to see all of our exhibitors. But wait, there's more. If you click to the right, there's actually more exhibitors, so don't miss out. Lots of promotions, lots of things happening, but what does it look like? So if we click on one of them, you'll see that it actually looks like a virtual representation of what the actual booth would look like if this was a physical in-person event. And you'll see that there's a welcome counter. There are also lots of different areas where you can take a look at their videos, their brochures. If you click on some of the brochures, it brings you in and you can see that there's a lot of information and also there are promotions going on. And if you have any questions for them, you can click on Enquiry and you'll be able to ask them questions, or you can ask them questions live. You can chat live with their representative by clicking on the lady on the right, and you'll be able to chat live with their representative. So that's the exhibition area. We definitely don't want you to miss out on that. There are many great offers going on. So also, folks, we will be starting this morning looking at an alternative approach to investing, specifically investing in the Hong Kong and China markets. So if you've never heard of DLCs, it's a great way to get exposure to a position while committing a lot less capital. And to tell you all about how to utilize DLCs, we are very glad to have with us Mr. Huan Zi, Deputy Dealing Manager from Phillip Investor Center, and Mr. Louis Wong, a Director from Phillip Securities Hong Kong and one of the best-known financial analysts in Hong Kong. So, handing the time over to you, Huan Zi and Louis.
Yes, thank you, Edward. Right, good morning, everyone, and welcome to Singapore Trading Festival 2022. My name is Huan Zi from Phillip Capital, and welcome to the first session of the booking day 3. Right, so we have a lot of events coming up for you, and so sit tight, relax, and enjoy the session. Right, so I'm going to introduce my company first, Phillip Capital. We are integrated Asia financial house with a global presence of more than 15 countries. All right, so we serve more than 1 million clients, and we have an AUM of more than 35 billion USD. Right, so we're the company behind Poems. And in case you haven't heard, we do have our newest app, right? So if you're interested, do look at our virtual booth and look at our social media as well. Right, without further ado, let me just pass the time over to Louis, who will start more on the Hong Kong and China market before I'll hand over to me and I will touch on the DLC. Yeah, Louis.
Good morning, everyone. Good morning. Thanks, Huan Zi. This is Louis Wong. I'm the Director of Phillip Securities Hong Kong and Phillip Capital Management Hong Kong. Today, I will touch upon, talk about the performance, the outlook, share with you the outlook of the Hong Kong market and some of the popular stocks traded in Hong Kong, which there are DLCs issued in Singapore. Okay, let's look at the performance of the Hong Kong market in the first quarter. I regret to say that the performance was quite bad. Hang Seng Index was down 8.5% year to date as of 27th March, last Friday. It went down from a peak of 25,051 points seen in early February and dropped to a low of 18,235 in mid-March. So the decline was more than 6,000 points in less than in around 1 month. But after the sharp sell-off, the sharp decline, you also saw a rebound lately from 18,235 to around 22,500. There was the rebound in the last half month. Okay, Hang Seng was down 8.5%, yet the Hang Seng Tech Index fared even worse. It was down 22.8% year to date, dropped to a low of 3,463 points, but currently it has rebounded to around 4,500 points. Okay, why did Hong Kong market fare so badly in the first quarter? Because we experienced a so-called perfect storm of headwinds. There are a lot of headwinds, namely the Russia-Ukraine crisis, geopolitical tension, and also US-China relations become even more tense. A hawkish Fed because of rising inflation. Now the market is speculating that there will be at least one or two 50 basis point rate hike from now until June. And then Hong Kong also experienced the COVID-19 surge starting from February this year. Our daily confirmed cases once reached more than 10,000 a day. And then property developers' default in China also dampened confidence, investor confidence. Adding to that, there was also the worry about the Chinese stocks, so-called 中概股, listed in the US may be delisted in future. And also, there's no loosening on the tightened regulation on tech companies in China. So these are all the headwinds the Hong Kong market is facing in the first quarter. Okay, our second quarter, we do expect the market has hit the bottom because of the drastic sell-off in the first quarter. So we expect stabilization of the market in the second quarter. It will be not as volatile as the first quarter. Some of the headwinds may weaken in the second quarter. For instance, there's hope that the peace talk between Russia and Ukraine may bear fruits. And also the COVID-19 in Hong Kong is getting better, slightly better now. So we expect a stabilization of the market in the second quarter. Our forecast index range for the Hang Seng Index in the second quarter is from between 20,100 to 22,700. We expect support around close to the 20,000 threshold, but we expect resistance around 22,700 because some of the headwinds are still there. Okay, today I will talk about a few of the very popular stocks that are traded in Hong Kong, and those stocks do have DLCs issued in Singapore, namely the ATMX, Alibaba, Tencent, Meituan, and Xiaomi. Alibaba, we reckon that the negatives still outweigh positives. The negatives include internet regulation risk and US delisting worries, as well as slowing growth. Okay, let's look at each of the negatives. Anti-trust restrictions is still weighing on the company. Bans on exclusive deals with merchants, aggressive promotional pricing strategies, and unapproved investment in smaller companies. This will limit the growth prospect of the company, and if there's any violation of those restrictions may result in hefty fines levied on the company. Chinese regulators have also asked state-owned firms to check their investments into and other linkages with Ant, which is now undergoing a restructuring before final listing. The listing, if you do remember, was called off earlier, and then subsequently it is undergoing a restructuring, and there are a lot of inspection into the company. Okay, About US delisting worries, the Holding Foreign Companies Accountable Act, which became law in late 2020, requires foreign companies to be more transparent in making accounting documents available. So this is the background behind the delisting woes of Chinese companies listed in the US. So delisting will be the ultimate consequence of non-compliance. If those companies listed in the US cannot comply with the law there, it will result in being delisted from the US. The SEC has announced 3 rounds of companies. Lately, that include iQIYI, Futu, and Baidu. So the market is expecting there will be more announcements from the SEC for companies that may be slated for delisting if they cannot comply with the accounting rules. Okay. Alibaba itself is also experiencing slower growth. Its third financial quarter revenue increased by only 10% year-on-year, and all major key performance metrics are down by double digits. For instance, income from operations decreased 86%, and adjusted EBITDA, non-JP measurement, decreased 27%. Its margins also saw a steep drop as a result of increased competition. Adjusted EBITDA margins fell from 31% in 2021 to 21% in the third quarter of fiscal year 2022. And also there's a lack of catalyst in its operating businesses. International commerce, local consumer services, digital media and entertainment, innovation initiative businesses are all still loss-making. Besides, we also saw a slowdown in China's retail sales growth, which becomes a burden for e-commerce dependent retailers. Alibaba may withdraw its sales guidance for 2022. Originally, it expected it's targeting 20% to 23% growth. But looking at the current situation in China, also we saw the spread of the surge of COVID-19 cases in different parts of China. It's likely that Alibaba may lower its sales guidance for 2022. Okay, so this is the price chart of Alibaba. It dropped to $71 from above $110 in early February. So after hitting a recent low of $71, it rebounded. Currently has rebounded to around 110. It met resistance at the 50-day moving average, which is the blue line, represent the 50-day moving average. And there's also steeper resistance around the 100-day moving average, okay, which is around above $120. So these are the near-term support and key supports, as well as near-term resistance and key resistance we have for the stock. So if you trade DLC, you may take a reference of those support levels and resistance level and decide your strategy. Our near-term support is around $99, slightly below 100. The key support would be around $80. Near-term resistance, 121, which is where the 100-day moving average lies. And key resistance is higher, about 10% higher at $135. Okay, that's all about Alibaba. Let's come to Tencent. Tencent also face internet regulation risk, but it's a different kind of regulation. Alibaba is more facing antitrust regulation, whereas Tencent faces the regulation on online game playing. As China has set limited video game playing time to 3 hours per week for teenage players on only Friday, Saturdays, and Sunday. So teenage players are not allowed to play online video games from Monday to Thursday. And the Cyberspace Administration of China, CAC, has unveiled new draft regulation requiring all online service providers to set up a youth mode for their services, stating clear limits in terms of user time, content, and functions. Okay. In addition to that, the new regulatory requirements will also translate into higher compliance costs. To comply with those new regulatory requirements will mean higher compliance costs that may eat into the profit margin of the company. Okay, Tencent is maybe also facing a possible huge fine going forward because its mobile payment product, WeChat Pay, may face a possible huge anti-money laundering fine for having loopholes that allow transactions to be used in money laundering and gambling. So this is one negative, one potential negative for the company. Tencent is also seeing slower growth in its profitability. Revenue grew only 8% in the fourth quarter, which is the slowest pace since its 2004 listing. And domestic gaming revenue grew a mere 1% due to a month-long licensing halt. There's no licensing of new video games in the last 7-8 months. So this is also negative to the company. And gross margins narrow under an international expansion. Okay. Its share price dropped to a low of $297 in mid-March and then rebounded. Currently, it's trading around between 370 to 380. So it has rebounded about 70 to 80 Hong Kong dollars from a recent low of $297. Our near-term support for the company will be 330. And key support is expected around 300. That is near the March low, 297. Near-term resistance. Actually, Tencent has rebounded quite strongly in this week and currently is trading above the near-term resistance. It has managed to breach the resistance of 370. So the next key resistance level we are looking at will be $400. Okay. Meituan, again, is also facing regulatory risk. Its extensive reach among riders and merchants has drawn scrutiny, resulting in regulatory action in the past 18 months, including a large antitrust fine and also requests to improve riders' benefits and guidance on anti-predatory pricing and merchant commission. The latest move directed on-demand delivery providers to cut commission fees. So all the delivery providers, they are already trading at very low profit margin, less than 4%. So with more regulations, more requirement to improve riders, to pay the riders better, we are afraid that there will be more downward pressure on the profit margin going forward. And most of the regulatory measures will certainly pressure Meituan's revenue and margin on implementation. Okay, we look at the financial results of Meituan. Fourth quarter revenue rose 31% on the back of significant new business income and stable food delivery growth. Yet, its net loss for the fourth quarter last year widened to 5.34 billion yuan from a loss of 2.24 billion yuan the same period the year earlier. So the loss more than doubled in the fourth quarter of last year. Due to the rise in sales and marketing expenses, which had surged 46%. And this marked Meituan's fifth consecutive quarter in the red, making losses 5 quarters in a row. Besides the antitrust fine imposed by the Chinese government in October last year, Meituan was hit by hefty increases in food delivery related costs. higher selling and marketing expenses and widening loss in its new initiatives business segments, which includes community group buying business, Meituan Select, Meituan Youxuan. So Meituan is trying to go into the e-commerce arena to compete with Taobao and JD. Yet it's very competitive at the moment. And just now earlier I mentioned that now China's retail sales and e-commerce are slowing down. So it would be difficult, it will be challenging for Meituan to develop its e-commerce business. Okay, Meituan's CEO has repeatedly warned investors of more losses to come in the next quarter as it continues to invest in the sector to seize market share. So this is the outlook for Meituan. Its share price dropped from about $200 to a recent low of 103.5, and lately it rebounded to around 140, 150. The near-term support for Meituan will be 125 Hong Kong dollars. Key support is 110, slightly higher than the 103.5 low seen in mid-March. Near-term resistance is 150. Key resistance will be 165. Okay, Xiaomi is one of the exceptional, that did well in 2021. It recorded a 33.5% growth in total revenue for the year 2021, while the adjusted net profits rose by 69.5% from 2020. Its global smartphone shipments grew 30% last year to reach 190 million units, ranking it number 3 globally with record high market share of 14.1%. As of December 31st, 2021, the number of connected IoT devices on its AIoT platform reached 434 million, up 33.6% year-over-year. And revenue from overseas markets reached 163 billion yuan in 2021, increasing 33.7% year-over-year and accounting now for nearly 50% of total revenue. So Xiaomi now, the revenue stream is quite diversified. About 50% comes from its home market and the other 50% comes from overseas. Okay, but there are uncertainty as it tries to get into the very competitive EV industry, the electric vehicle industry. It plans to pump $10 billion in the next 10 years into its EV division. It will construct a production plant in Beijing that will be capable of producing 300,000 electric cars per year. But it will take about 2 years for the company to reach mass production by the first half of 2024. But within the next 2 years, we are afraid that the EV market, in China will become even more competitive as there are more newcomers joining the industry. Now you have all the new so-called new forces, Xiaopeng, NIO, and Li. With more conventional vehicle manufacturers and also startup companies venturing into the EV space in China, the competition has become tighter. Xiaomi also saw its share price on the downtrend since September last year. It hit a low recent low of 11.38 and then rebounded to around $14. We expect near-term support at $13.50. Key support will be around $12. Near-term resistance is expected at 15.5 Hong Kong dollars, and key resistance level is 17 Hong Kong dollars. Then we move to the car makers, BYD. BYD is principally engaged in automobile business, which includes new energy vehicles and traditional fuel-engined vehicles. It also manufactures handset components and also has other assembly business. It also made rechargeable batteries and photovoltaic business, as well as the urban rail transit and other businesses, which the group has actively developed by leveraging its own technological advances. BYD is a company that focuses a lot in R&D and spends a lot of in R&D. So it is a market leader in the EV industry. Sales volume of new energy vehicles last year saw more than 200% to more than 600,000 in 2021. And he expects its sales volume this year to double to 1.2 million, comprising 600,000 units of BEV, pure electric vehicles, and 600,000 units of PHEV, the so-called hybrid electric vehicles. The group's market share of the new energy vehicle market currently stood at 17% and is expected to further rise to 25% in 2022. Okay. What stands out, BYD is vertical integration. BYD has the capability to manufacture battery cells and IGBT transistors, the two most expensive components in an electric car. So it can be self-sufficient by supplying itself with battery cells as well as transistors. Vertical integration has allowed the company to shorten the development life cycle and lower overall costs by spending more time on research and solving potential integration problems ahead of time. So that is competitive, core competency over other competitors. Its share price dropped to $165 in mid-March before the result announcement. But after result announcement, because its share price rebounded back to about $200. We expect near-term support around 200. Key support will be at 175 Hong Kong dollars. Near-term resistance is 230, and the key resistance is 255, is where the 100-day moving average, this black line, lies at 255. And 230 is where the red line that represents the 250-day moving average lies. Okay. We'll also look at another car maker, Geely. Its performance so far was tepid last year. Sales volume was only up 1% at 1.3 million, below its own target of 1.5 million for the year. And the company attributed the delivery volume miss to the global chip shortage that has constrained its production across the world. However, revenue was up 10.3% year-on-year to 101.6 billion yuan in 2021, but profit attributable to shareholders was down 12.4% to 4.85 billion yuan. Excluding share-based payments of more than 6 billion yuan, profit attributable to shareholders of the company was actually up 9.4% year-on-year. So rather lackluster performance. Revenue was up by around 10% and profit attributable to shareholders excluding share-based payments was up less than 10%. Gross profit margin was up 1.1 percentage point to 17.1%. Its outlook will remain challenging as the company states that semiconductor supply shortage shows no sign of subsiding in 2022, and rising competition in China and the country's tightening pandemic curbs and higher raw material prices amid global inflation could add further pressure on sales and margins this year. The company targets sales volume for 2022 at 1.65 million units, 27% higher than the actual sales volume achieved in 2021. But looking at the sales volume reported in the first 2 months this year, it was already behind the target. We expect that it will be very challenging for Geely this year to meet its sales target, which is rather aggressive. Okay, the share price dropped to a recent low of $10 and now rebounded to around $11.50. We expect near-term support at 11 and key support level will be $10. Near-term resistance is expected at 12.50 Hong Kong dollars and key resistance is 14.2, which is near the blue line, the 50-day moving average. This biopharma company will also talk about WuXi Biologics. Its revenue increased by 83.3% year-on-year to 102 million. That is 10.209 billion yuan in 2021. Net profit grew more than 100%, and total backlog grew 20% to $13.5 billion in 2021. So the backlog implies that the company will have the steady orders on hand and further growth momentum is expected. The group continued to expand its customer base last year. Total number of customers increased to over 470, including all the top 20 global large pharma. And the number of last year it benefited from COVID-19 projects as there was strong demand for vaccines and also medicines to cure COVID-19, the COVID-19. But the number of non-COVID-19 projects also grew very strongly to 447 with strong revenue growth and expectations. So it demonstrated that the group's robust business momentum it can remain robust going forward, the business growth even without COVID-19 projects. So it's not over dependent on COVID-19 projects. Okay, share price dropped from around $130 seen in the third quarter last year to a low of $40.3. So a drop of nearly 60 to 70%. Now it rebounded to $65. We expect near-term support at $57, which is where the 10 and 20-day moving averages lie. Key support will be around $50. Near the gap, the upside gap seen in on the 17th of March. And near-term resistance is expected around $70, where the 50-day moving average lies. Further up, key resistance level will be $80, okay, near the 100-day moving average. Okay, so I will hand over to my colleague, Huan Zi, to talk about DLC.
Right, thank you, Luis. Right, so I will take over and share my slide on my end. Give me a moment. Okay. Right, I think you can see my slide right now. So thank you, Luis, for sharing on the Hong Kong and China market outlook, especially some of the counters that might interest investors. So I want to actually touch on how you can actually take advantage of such opportunities through the use of DLC. All right, so let me start. Okay, so DLC itself actually have exposure, all right, into Hong Kong underlying. Of course, we do have Singapore and also the S&P 500. All right, but for Hong Kong counters, we have around 40 Hong Kong counters, more than that. as underlying through the DLCs, and 3 Hong Kong indexes that can be traded via the DLCs itself also. So currently we have SocGen and UBS as the providers for the DLC on SGX. And some of the examples that you might interest you are actually shown. So Hang Seng Index, Hang Seng China Enterprise Index, and so the Hang Seng Tech Index. All right, so for index itself, there is the 5-time and 7-time leverage DLC compared to the stock DLC, which generally is 5 times only. But do take note that for DLC, you can actually engage in both long and short. Right, so that actually helps you with your potential of trading, because instead of only buying on a bullish momentum, you can also buy at a bearish momentum. I'll explain more later. Okay, so a very brief one for DLC. Basically, it's an exchange traded, so you can trade it on SGX like a stock, and you can take a leverage exposure to the underlying asset, so such as your underlying of Hang Seng Index or Alibaba or even Meituan or Tencent. All right, so the liquidity is there, right? Because there is market makers that help you create the liquidity, even if you do not see the volume already in the market. But the market makers do have queues in place so that if you want to trade on it, the volume is there for you. And it's transparent because it's always traded and the price is live. All right, and it's simple because it's like a traded in the same day, right? It's a buy and sell, buy low, sell high. Strategy for you will work as well. All right. Okay, so a very brief comparison. I won't go into too much detail here, but the idea is that for DLC, it compares with the other leverage products. So first thing is that it is exchange traded, and there is no risk of margin call, while your maximum loss looking at trading DLC would be the initial capital only. So in the case of worrying investors that worry that you might lose more than capital due to trading on a leverage product, DLC actually helps to maximize, sort of limit the risk you are taking, because the maximum loss you will take is the initial capital. All right. Next thing is that there is a fixed leverage factor, which compared to some of the other leverage products, it might be varying depending on the underlying. But for DLC, you can actually directly see what is the leverage factor when you are trading on it. So you can see over here the benefit of DLC. First, of course, I mentioned the fixed leverage factor. There's no margin call. And then the next thing is the most important for, I think, a lot of investors is that you want to have the opportunity to trade into both the bullish and the bearish scenarios, all right? And you can also participate in the volatile short-term swings. So example, on the right-hand side is a counter code, right? DANW, which is the SGX code you can search for the DLC. It is a very simple way to read the DLC name. So the Tencent is underlying. You have the 5 times, which is the leverage ratio or leverage factor. You can see whether it's long or short over there. The SG issuer refers to the SocGen. If you see UB, you'll be under UBS DLC. All right, then there'll be the expiry date on right-hand side in the year, month, day format. All right, so basically the DLC daily performance on the bottom right is actually equals to the underlying daily performance times the leverage factor. So if let's say Tencent move down by 1%, this Tencent long index will move down by 1% times 5, because it's a 5 times leverage DLC. All right. So basically for DLC, there is compounding effect. So to let you illustrate what this means is that this is the infographic. So let's say Hang Seng Index starts 24,000, and over the course of 3 days, it moved 2% each day. 2% based on the previous day closing each day. Total, if you do compounding on the index itself, it moved 6.12%. All right. In the 5 times leverage factor, you might, if you use a simple calculation, it should be 30.60%. But because of the price marking and the compounding effect of the DLC, you actually see a 10% growth each day, which totals to 33.2% increase in the value of the DLC instead. Okay, so the compounding effects actually helps investors if it's on an uptrend. So if it's a consistent uptrend, you can see the compounding effect might come into place and help you to get a better return. On the reverse side, if you see a falling market and you're in a long position, all right, you actually see that the losses, right, if you compounded, also be slightly less than the simple calculation of 5 times of the total loss itself. So if you drop 2% per day for 3 days, is a drop of 5.88%, times 5, 29.4%. But in the DLC, it only drops 26.8%. All right. So, however, just take note that for DLC, right, it's more for short-term trading. And you should actually have a direction in mind, because if it's a very volatile market where it's going up and down, right? So example, in this situation, where Hang Seng dropped 3% the first day, 4% the next day, and then it increased 9% on day 3. On the index level itself, there is a gain of 1.5%. However, for DLC, because of this situation and the leverage factor performance per day, the calculation of the DLC result will be a negative 1.2% instead. All right. So there is to take note of this risk involved. So compounding can take place and help you if it's a consistent uptrend, or help you to limit the losses a bit more if it's a consistent downtrend. But if, let's say, it is a volatile market, then the DLC might not perform as well as compared to the index itself. Okay, so it's a very simple illustration of how it looks like if you search for DLC on SocGen or UBS website. You can actually see the stock codes on the left hand here, and then the names, and then the long or short that is available through the type column. All right, you can also see the trading volume and also the B and ask pricing. Right, so this is a very simple illustration of how you search for counters to trade. In this case, I search for Tencent available DLCs. Okay. Okay, so example, now I want to illustrate, okay, so Louis have shared on how the outlook could be like for both the Hong Kong index and also on the available counters he mentioned. So I actually zoom in on Tencent itself as an illustration point. So let's say you're going to trade DLC because you have a certain momentum or certain belief of the price movement due to the earnings results, right? So in this case, there was an earning result for Tencent on 23rd of March after Hong Kong hours, right? So if you see the high and low of the Tencent performance on 23rd of March is before the earnings result. So it closed at 389. But if you see the next day on March 24th, directly it closed at 366, a decrease already. And subsequently on 25th of March, it declined again further due to the market condition. All right. So example is this. So if you actually use and you actually had the belief that Tencent might drop and you engage in the 5 times short DLC during this period of time, right? If you see the left-hand side, from 23rd to 24th and 25th, right, there is a decline of 5.91% for the stock price and 2.62%. All right, for DLC itself, then you would then have a multiplied effect. But of course, in real life, because of the commission cost and the trading, and also there might be a small spread compared to the intrinsic closing value, you might see that the leveraged return of the DLC at 26.83 as highlighted might be slightly less than the 29.31 in theory if you use the daily performance times 5. Okay, and why is it a positive return? It's because you are in a short position. So when there is a decline, a drop in Tencent price, this DLC actually goes up instead of going down. Okay, so other than, of course, earnings results, some of the factors that you can actually use to determine whether or not you engage in these short-term trading opportunities for Hong Kong counters could be things like the earnings result, the government regulations, even economic indicators such as the interest rate announcement, tax policies, GDP, and also exports numbers, especially for the trade relations. All right. So of course, there's also correlated factors such as the competitors, the suppliers, and customers. All right. So one more thing is that for economic indicators, is not only for domestic. For a lot of these companies that might be also dual listed in the US, or they might actually have exposure to the international market as an audience, then you can also look at both economic indicators of the domestic market as well as the international market is exposed to. Okay. Okay, so basically, this is an example that I gave, all right, if you're trading for leveraging purpose. So if you're trading on a shares basis, right, you see, for trading of the Hong Kong shares, a lot of them actually have a minimum lot size. And take example, in this case, I use Tencent, which is a lot size of 100. For each lot size value, right, you have a minimum investment amount of around 6,000 Sing, after including 35,000 Hong Kong dollar, which is near 6,000 Sing. So that is the minimum investment you are going to make to trade. And you have to trade in multiple of these due to the lot multiple, all right? So that's assuming a 12.3K investment around 200 shares of Tencent. Okay, in the case of the same exposure or the same value of investment, 12.3K, using the DLC of DDLW, which is the 5 times long Tencent index, you can actually use the price of 0.05, which I used at the point of time of the 25th of March, at that price point, you're looking at 246,000 shares of the DLC to get a $12,300 investment. So for the same investment, you actually have an exposure of ×5 because it's a ×5 DLC, right? So your exposure is actually 61,500 worth in Sing dollar equivalent. Okay, so assuming the closing is 28th of March, 1 day later due to the weekend, and the price actually increased to 366.4, right? The value of investment for the share itself is 73,000 Hong Kong dollar. All right. So the change in Hong Kong dollar is around 2K Hong Kong dollar, around 350 Sing dollars, or 2.8%. This is the change in the value for the shares itself. But you look at the DLC, due to the increase in the multiple effect, ×5 multiple, you see a real closing price of 0.06. Of course, intrinsic value is 0.062 at the point of time, announced by the distributor. But even at 0.06 alone, you see that the increase is 2,460. So this is an increase of 20%, all right, due to the market price of the DLC when it's trading at. So the first thing is you actually have a more flexible exposure control because of the leveraging using DLC. You can control how much shares you want to buy. So if you want to have a 12,300 investment, then the limit to only 5,000, 4,000, and then multiply the exposure to 20K, right? You can actually do so due to the number of shares you can control to buy for DLC. As compared to the shares of Hong Kong counters, you have to directly enter into minimum lot size itself. Okay, so these trading opportunities come in mainly when you want to trade on the rebound. Maybe there's overcorrection, like example in the mid-March period, there's a rebound after that. When you tap onto the rebound period, you can actually use DLC for the long, or there's more regulation clarity, which actually caused the rebound. And also maybe US SEC regulation risk might be a bit more muted, for example, or if it's heightened, then it might be a short DLC opportunity. All right, and also for example, for this case, Tencent, there is a direct correlation to the gaming industry. So gaming industry news will also affect the counter, not only for economic factors itself. Okay, so this is for leveraging function. So for hedging itself is, let's say you already have an exposure on the stocks itself in Hong Kong counter, right? You have your own investment there, and you want to hedge your position. You know that there might be some movement that will be actually negative to your long position of the shares. You can actually use a short DLC to actually cover the exposure. So for example, if 100 shares of the Tencent share again, right, 23rd of March, I'll be using this, 23rd of March versus 25th of March pricing, as an example. So 200 shares of the Tencent shares in this case is around 77.8 thousand HKD, all right? So around 13.4 thousand Sing dollar exposure. So for the same exposure, you're looking at the same exposure value of 13.4 thousand, you only need to use 2,680 Sing dollars equivalent before cost as a DLC exposure. So you inject in this 2.7 thousand roughly worth of value in Sing dollars into a DLC to hedge your position. Okay, so with the hedging position, you can see that with the price change on the 25th of March, there is a decline of 6,000 Hong Kong dollar due to the results itself that was announced by Tencent. So 6,000 HKD drop in value of the shares, which is around 1.1 thousand, is actually covered by your exposure on the DLC DMIW, which increased in value of around 1,300 or so. So it actually slightly more than covers the loss that you see in the shares. All right. So the losses in the share is around 8%, while the increase in value of the DLC is around 50%. But these two bills is the exposure level. The net amount you're actually looking to get, right, is actually to cover the losses that you see in the shares. So you can choose to close the DLC at this point of time, and then you have the profit. Technically, it sort of reduces the cost of your shares to the current share price. Okay. So of course, if you do not want to trade on a direct hedge, right, directly hedging through the Tencent short DLC, maybe because you have more than Tencent. If you have more than Tencent, like Tencent, Alibaba, Meituan, you have all of them, you can actually hedge using the Hang Seng Tech DLC because of the tech exposure. But in this case, as an example, I use the 7 times Hang Seng Index short DLC to show you the 7 times effect. So you actually, instead of 2,680 Sing dollars as a hedging for exposure value, you can actually use the 7 times hedge and only use around 1,009 Sing dollars as a hedging value. So only need to put in another $1,009 Sing to actually hedge the position. And with the hedging position, of course, the value in this case is not sufficient because the increase in value of this short 7 times Hang Seng Index DLC, the increase in value is less than the reduce in value of the shares in this case. However, the idea is that there is a semi-hedge function there, and the main reason why it's not a full covering of the results is because the tech stocks drop more than the Hang Seng Index itself. So the tech stock actually, if you correlate the results, the tech stock actually drop more. Thus, the short DLC of the index itself is not sufficient to cover the individual stock drop itself. Okay. Okay, so other than that, I want to just mention that we do have also the DLC opportunities for Singapore Index and Singapore counters and even S&P 500 available. And also we also have the leverage inverse ETF if you do not want to engage in DLC, because you're scared of the high leverage of 5-7 times and do a lower leverage factor. We have a ×2 factor or times -1 factor for inverse ETF available as well. Okay, so depending on your thing. So now let me move to the Q&A. All right, Q&A. So if any questions, do put them in, and then we can actually answer them. So together with me, Louis also answer some of the questions that might be asked in the audience. Right, Louis, maybe you take any questions interesting to you?
I think the question from Market Sim, he's asking whether the outlook for April is bearish due to regulatory concerns. As I mentioned earlier, the headwinds are still there, but it's not as bad as in the first quarter. So we saw the sell-off done in the first quarter. We expect stabilization in the second quarter. But do not expect very big upside for the Hang Seng Index in the second quarter, both Hang Seng Index and the Tech Index, because of those headwinds I mentioned earlier. Regarding BYD, I also like to answer reply in Kwong's questions about BYD. Whether semiconductor shortage will affect the company's performance in this coming year. Yeah, the answer is yes. But with the capability of supplying its own battery cells and transistors, it will stand slightly better than other competitors who have to rely on external suppliers for the battery. Because the battery accounts for more than 40% cost, manufacturing cost of an EV. Okay. FH Tan asks if Liu He, the economic advisor to President Xi Jinping, recent statement about the market, does it have any impact on the Hong Kong and China market or any counters which is benefits that? Yes, actually the rebound in starting from mid-March, the strong rebound was partly attributable to the positive statements made by Liu He that the government will roll out more supportive and stimulus measures to support the economy. I think that's attributable to his positive comments. But of course, the market will wait for actual actions. We'll want to see actual actions and actual results before the index can go further up. Okay. This is also related to Grace Poon's question. She's asking about Chinese banks. As Fed interest rate is going up, is it good to invest in China banks? China, on the contrary, because of the slowing down of the macro economy, is expected to further to adopt a loosening monetary policy. It will reduce the RRR, the reserve requirement ratio, further, and also there's the possibility of cutting interest rates this year. So it will have different impact on Chinese banks. Cutting interest rates may exert downward pressure on the interest margin, but we don't expect very aggressive cuts by the PBOC. So every time they may cut interest rates by only 5 basis points. So the impact on the interest margin of Chinese banks will be quite minimal. But if those cuts and also the reduction in the RRR will be able to stimulate loan demand, then it will benefit the banks. And also recently we noticed that there's a switch into high yield stocks, the stocks that are defensive as well as with high dividend yield. So both Chinese telco operators such as China Mobile and China Banks, which are yielding more than some Chinese stocks banking stocks are yielding more than 8%. So they are actually attracting new fund flows, new fund inflow. So we do expect Chinese banks to outperform the market this year. If you look at the first quarter, all the Chinese banks actually they outperformed the Hang Seng as well as the China Enterprise Index. The average rise in the first quarter in their prices is around more than 10%. Okay. As for Chinese property stocks, we expect divergent performance going forward. So those companies with state-owned and parents' background will be favored by the market because they have lower leverage as well as they don't have the mines, the time bomb of debt default, and also they will be able to, because of the cash flow, the healthier cash flow, they will be able to continue to replenish their land bank by buying by bidding at land auctions. And because of the recent slowdown and correction in the Chinese property market, now land acquisition becomes cheaper, which is favorable to those companies who still have the capability to buy land. We favor companies such as China Overseas Land, COL, CR Land, and Poly. These are all state-backed companies. Okay.
Louis, yeah. Because I think time constraint. Let's have a last question, which is from John, regarding Hang Seng on the Hong Kong index compared to the Shenzhen and the Shanghai indices, the CSI 300. Like he's asking whether or not CSI 300 or the Hang Seng index is more expensive or cheaper.
I think the constituents are different. While recent years there are more and more tech stocks as constituents of the Hang Seng index. So the sell-off in the tech sector because of worries of more regulatory risk add pressure to the Hang Seng index. I think this is due to the different constituents, the different composition of different constituents.
Okay, thanks, Louis, for sharing. Okay, so thanks everyone for joining for the first session. Let me pass the time back to Edward. All right, thank you. Edward, please.
Thank you very much to Huan Zi and to Louis.